Hello and welcome to the IG Index online seminar, Forex Trading Explained. My name is David Jones, and over the course of the next few chapters I'm going to hopefully demystify Forex trading for you, how the foreign exchange currency markets work and how you can trade them using spread betting. Before we start, just because we're going to talk about it from a spread betting point of view, let's do a quick recap on what spread betting is and how it works. It's important to remember that spread betting is a leverage product and can result in losses that could exceed your initial deposit, first of all. Spread betting may not be suitable for everybody, so please ensure that you fully understand the risks involved. But spread betting is very simply a way to speculate on financial markets. A spread bet is simply a contract that mirrors the movements of a financial instrument, wherever that instrument is, whether it's a share like BP, an index like the FTSE, a currency pair like the pound against the dollar, or a commodity such as the price of gold. As with other forms of trading, your profit or loss is governed by the price you buy at and the price you sell at. Unlike other forms of trading, spread betting does not attract additional commission. There's no stamp duty to pay, and any profits are tax-free. We have to say tax law can of course be changed or may differ if you pay tax in a jurisdiction other than the UK. So let's talk about Forex. What is Forex? So Forex, foreign exchange, the currency market, FX, call it what you will. It's the largest market in the world, bar none. In the latest report from the Bank of International Settlements, daily volume in Forex markets exceeded $4 trillion a day. That's day in, day out. It's an absolutely enormous market. And of course that is part of the reason for the appeal, which we'll come to a little bit later on, just the size of the market. So even over the last 3 years, volumes traded in FX have jumped by 20%, and it continues to be an incredibly popular market amongst our clients as well, traditional UK retail clients. Foreign exchange is the simultaneous buying of one currency and selling of another. So currencies are always quoted in pairs. If you said, for example, oh, today the pound was very strong, it's only really half the story, because a currency has to be very strong in relation to another currency. So if I look at the watch list I have set up on my screen here, I have some currencies in the watch list here. So pound against the US dollar is currently trading at 154.15-ish. It's up 60 odd points on the day. So this means the pound has strengthened, but conversely, the US dollar has weakened because the pound is up against the dollar. If we look at this one down here, dollar yen, so dollar yen is trading around about the 8,400 mark. It's down 12 points on the day. So the first quoted currency, the US dollar, has weakened, and correspondingly, of course, the yen has strengthened. So it really is like a three-dimensional market. It's also a true 24-hour market. It follows the sun around the world. So trading starts early evening, well, sort of 9 to half 9 on a Sunday evening, UK time, when the Asian and Australian markets open up for business. And then when they finish up, maybe 6, 7 in the morning, focus switches to the European markets. Then when we all finish up here, around about 5 in the afternoon, focus switches to New York. When they close up, it goes back to the Asian market. So it really is a true 24-hour market. We're quite fortunate here in the UK because London is still regarded as the global centre for foreign exchange. It's fair to say most of the volume transacted in foreign exchange markets happens during London's trading hours. So we're still seen as an FX centre here in the UK. Probably for no other reason than we are sort of slap bang in the middle of the time zones. That definitely doesn't do us any harm. And most of the major financial institutions, the high street banks, the hedge funds, all of that will have a Forex trading operation of one form or another. And for many of them, they are massive parts of their business. Foreign exchange is an interbank market. There's no central exchange. Let's just take a step back from that. If you wanted to buy, for example, shares in Vodafone, they trade on the London Stock Exchange. If you wanted to buy shares in Microsoft, then they trade in the US. If you want to buy pork belly futures, then they trade on the futures exchange in Chicago. So most markets do have exchanges they trade on. FX is slightly different. There's no central foreign exchange. It's an interbank market, so it's basically banks, and it is primarily banks, trading with each other. So if I'm a bank and I'd like to buy 100 million worth of sterling against the US dollar, then I need to find another bank to take the opposite side of the trade, which makes it sound from that point of view quite inefficient. But again, due to the size and due to the size of the participants involved, it's arguably the most efficient market in the world because there is just so much money flowing through it, and we're talking about such humongous trades, which again, from us, from a retail point of view, is great because if it's an efficient market, arguably it makes it one of the more cost-effective markets from a viewpoint of the cost of trading for us to trade. When it comes to who's active in the various foreign exchange markets, various currencies, participants include investment banks, as I've mentioned. Most of the major financial corporations, financial trading houses around the world will have an FX trading arm. Central banks, of course, can play their part from time to time, whether it's the Bank of England, the European Central Bank, the US Federal Reserve, the Bank of Japan. They will be active in markets, either propping up their own currency. Maybe we saw a lot of that when the euro first came to the markets at the beginning of this century, and we saw a lot of activity by the European Central Bank attempting to stem the weakness of the euro, or maybe just adding to their own particular currency reserves. So central banks, again, have a role to play. Hedge funds, of course, very popular market with various absolute return funds because of the volatility involved in these markets, and the size in these markets makes it very easy to get large trades filled. And corporations, if we think about it, probably the sole reason that FX markets started off was for international businesses to hedge away their currency risk. If I'm a UK company and I do a lot of business in the US, and let's say I made 20 million US dollars profit last year in my US operation, but I report all of my profit and loss, my annual returns, all get done in pound sterling, then I have a currency exposure. At some point I've got to convert, whether I do it physically or just from an accounting point of view, convert those US dollar profits back into my home currency. I've got a currency exposure there. So again, international corporations who do business around the world will be active in foreign exchange markets, normally through their investment banking partners, to hedge away any currency risk that they may have.